You know that feeling? You're doing absolutely everything right, working your tail off, saving every extra penny, but somehow buying a house still feels like a total pipe dream. Well, you're not crazy. A massive structural shift just happened, pushing the average American home to a frankly staggering new price tag. And the underlying math? It's literally designed to trap millions of people in the rental market.
So let's talk about the breaking point. $486,000. That's the new national average home sale price. Now, sure, you might see headlines about the market softening in a few Sunbelt cities, but the reality on the ground is completely polarized. Premium properties are commanding such insane prices that they're dragging the whole national average up with them. Since 2017, average earnings across the country grew by about 43%. Honestly, that sounds pretty solid, right? Well, not when you realize that national home prices surged by 81% over that exact same window. The entry-level market is just evaporating, cementing this massive wealth gap. But to really grasp why this is so devastating, we gotta look at what's eating your paycheck before a mortgage is even part of the conversation.
Because, let's face it, housing affordability doesn't just exist in a vacuum. It's being suffocated by the stuff you literally have to pay for every single month. Look at these numbers. The cheapest silver health insurance plan on the marketplace, up 77% since 2017. That's $611 a month. Electricity is draining about $154. Groceries for a typical family are hovering around $1,050. And thanks to some recent global shocks, gas just leaped a full dollar per gallon since late February, hitting $396. This massive inflation on the absolute bare bones essentials is bleeding dry the exact cash flow families need to even think about saving for a down payment. And when your basic survival costs that much, what happens? People are forced to lean on revolving debt just to get by, and consumer credit is taking a massive hit. The national average credit score is basically flatlined at 696. Credit card and auto loan delinquencies are both creeping past 5.5%. Student loan delinquencies, a painful 15.9%. Here's the real trap, though. Even if you somehow make a high enough salary to theoretically afford a mortgage, dealing with this kind of debt-to-income stress makes getting a favorable loan almost impossible.
For decades, renting was just a stepping stone, right? You rent a place while you save up for the big purchase. Today, that pipeline is totally jammed. We're staring at this fundamental, unprecedented misalignment in income. To comfortably afford a median-priced home right now, a household needs to bring in at least $111,252 a year. But to rent a standard apartment, you only need between $64,500 and $76,020. Just a few years ago, owning a home meant you needed about 17% more income than renting. Today, you need 81% more income just to buy.
That massive gap leaves the average American family completely stranded. The median household income is sitting right around $86,185. Think about that. The typical family makes more than enough to comfortably afford a rental, but they fall exactly $25,067 short of the income needed to even qualify to buy a home. So what actually happens when millions of people are just mathematically blocked from owning property?
Well, the entire demographic fabric of the country starts to shift. The median age of a first-time homebuyer has hit a historic high of 40 years old. Back in 1980, it was 29. This incredible 11-year delay isn't just some boring real estate stat. It is directly linked to declining national birth rates. Young adults are putting off marriage, they're delaying having kids, simply because they cannot lock down stable housing.
It's like the ladder is literally being pulled up. Entry-level buyers are being systematically boxed out of the market. Get this, first-time buyers recently made up just 20% of all home purchases. That is exactly half of the 40% market share they commanded back in 2007. So if you're a prospective buyer today, you are forced into this brutal calculation about opportunity cost. Because let's say you actually managed to scrape together a standard 20% down payment on a medium home. You are looking at parking at nearly $80,000 in illiquid equity. You can't touch it. But what if you just keep renting and toss that exact same amount into a diversified investment portfolio, getting, say, a 6% annual return? Over 10 years, that grows to about $159,000. With the barrier to entry this ridiculously high, renting and investing is actually becoming a highly liquid, completely valid alternative to homeownership for an entire generation. Now, you might be wondering, why on earth isn't the market correcting itself? For that, we have to zoom out to the macroeconomic picture. Everyone was bracing for some relief when the Federal Reserve cut rates in late 2024 and into 2025. And for a minute, mortgages did start drifting down. But then February 2026 hit. An unexpected overseas conflict involving Iran disrupted international trade routes. Boom. Global oil prices spiked, inflation fears roared right back, and 10-year U.S. Treasury yields climbed. That whiplash dragged average 30-year fixed mortgage rates right back up to 6.43% by May. And here is where things get really crazy. That macro event created what we call the Great Mortgage Lock-in. Right now, 48% of U.S. homeowners are sitting on mortgages with interest rates below 4%. The data shows us that the moment rates creep past 5.5%, there's this massive psychological wall. Nearly 3/4 of homeowners outright refuse to sell if it means trading their cozy, low-interest loan for a new one at 6.4%. I mean, in states like California, making that trade would add $180,000 in extra interest over the life of the loan. No way people are doing that. So they stay put. They remodel instead of moving. Existing inventory freezes solid, and transaction prices just stay permanently sky high.
But elevated rates aren't just freezing the housing market. They are introducing a massive macroeconomic risk. If Treasury yields stay this high, the net interest we pay on federal debt could balloon to over $2.5 trillion by 2036. This sets up a terrifying little formula for economists. R is greater than G. Basically, that's the exact moment when the average interest rate on government debt outpaces actual economic growth. Why does this matter for housing? Because a national debt spiral could mathematically crowd out any future public investment in housing infrastructure. The government simply won't have the cash to help bail out the market. So, with existing homes locked up by that interest rate effect, the only logical way out is to just build new ones, right? Well, builders are getting slammed by a continuous supply shock. We're currently sitting on a national deficit of roughly 4 million homes. First, you've got an extreme skilled labor shortage causing almost $11 billion in economic losses a year, which literally translates to 19,000 single-family homes just not getting built. Then, you pile on global trade policies that are slapping tariffs on industrial metals. Copper is up nearly 25%, steel is up 21% year over year. For a home buyer, that creates a hidden tariff tax that tacks on $17,000 directly to the baseline cost of every single new home built. This whole multi-layered mess has triggered a massive, incredibly high-stakes policy collision in Washington. We're basically watching the legislative branch and the executive branch speed in completely opposite directions. On one side, you have Congress desperately trying to unlock private investment to just build more housing. But on the exact same timeline, the current administration is making aggressive moves to cut public funding, proposing a 13% slash to the Department of Housing and Urban Development's budget. Let's look at the legislative side first, because we're seeing a truly historic push here. In May 2026, the House overwhelmingly passed the 21st Century Road to Housing Act. We're talking a staggering 396-13 bipartisan vote. It's designed to slash supply barriers by exempting smaller housing projects from those super expensive environmental reviews, and it finally allows modern, low-cost, factory-built modular homes to get standard financing. But the biggest deal for everyday buyers, it strictly bans large institutional investors, the ones owning 350 or more properties, from scooping up existing single-family homes. It is a massive push for deregulation and getting more supply on the market.
But that brings us right to the ultimate unresolved conflict. While Congress is trying to clear the runway for private capital, those proposed executive budget cuts would completely gut the core community development and affordable housing grants that state and local authorities desperately rely on. We aren't just looking at a shortage of wood and nails anymore. We're living through this fundamental structural divide, where the income required to buy the American dream has completely outrun the reality of the American paycheck, which leaves us staring down one massive question. Can the market actually build its way out of a 4 million home deficit using purely private capital and deregulation, or will cutting those public housing grants permanently lock an entire generation out of the American dream?